Module 6P/E ratio and earnings quality. Assessing the quality and sustainability of a company's earnings is essential when evaluating its P/E ratio. Here are some key considerations to help evaluate the quality and sustainability of earnings in relation to the P/E ratio. Revenue and earnings growth. Analyze the company's revenue and earnings growth trends over multiple periods. Look for consistent and sustainable growth, as it indicates a healthy business with the potential for future earnings expansion. Ensure that earnings growth is driven by core operations rather than one-time events or non-recurring factors. Profitability metrics. Evaluate the company's profitability metrics, such as gross profit margin, operating margin, and net profit margin. A company with consistent and improving profitability is likely to have more sustainable earnings. Compare the company's profitability metrics to industry peers to assess its relative position and competitive advantage. Cash flow analysis. Examine the company's cash flow statement to assess the quality of its earnings. Positive operating cash flows indicate that the company's earnings are translating into actual cash generated by its core operations. Adequate cash flows also enable the company to invest in growth initiatives, repay debt, and distribute dividends. Quality of earnings. Look for signs of earnings quality, such as low levels of non-operating or one-time items that may distort the earnings figures. Evaluate the company's accounting practices, including revenue recognition policies, expense management, and potential risks related to off-balance sheet items or contingent liabilities. Sustainability of competitive advantage. Assess the company's competitive advantage and moat. A company with a sustainable competitive advantage is more likely to maintain its earnings power over the long term. Consider factors such as brand strength, intellectual property, unique market position, and barriers to entry that protect the company's market share and profitability. Industry and market outlook. Evaluate the industry dynamics and market conditions in which the company operates. Consider how the company's earnings may be affected by changes in the industry, market trends, technological disruptions, or regulatory shifts. Assess the company's ability to adapt and thrive in a changing environment. Risk factors and business fundamentals. Identify and evaluate potential risk factors that may impact the company's earnings sustainability. These may include industry-specific risks, competitive pressures, regulatory risks, macroeconomic factors, or company-specific issues. Conduct a thorough analysis of the company's business fundamentals, including its management team, corporate governance, balance sheet strength, and ability to navigate challenges. By considering these factors, investors can gain insights into the quality and sustainability of a company's earnings. This assessment, in conjunction with the company's P/E ratio and other valuation metrics, helps paint a comprehensive picture of the company's investment potential. Accounting practices, non-recurring items, and one-time events can have a significant impact on the P/E ratio of a company. Here's how these factors can influence the P/E ratio. Accounting practices. Accounting practices can affect the P/E ratio by influencing the reported earnings figures. Different accounting methods and policies can result in varying earnings calculations, which in turn impact the P/E ratio. For example, companies using aggressive accounting practices may recognize revenues or defer expenses in a way that inflates earnings. This can lead to a lower P/E ratio, as the reported earnings may not accurately reflect the company's underlying profitability. Non-recurring items. Non-recurring items refer to one-time events or transactions that are unlikely to recur in the future. These items can include gains or losses from asset sales, restructuring charges, legal settlements, or other exceptional events. Non-recurring items can distort the company's earnings in a particular period, making it necessary to adjust the earnings to get a clearer picture of the company's ongoing profitability. If non-recurring items significantly impact earnings, the P/E ratio based on reported earnings may not accurately reflect the company's underlying earning power. One-time events. One-time events, similar to non-recurring items, are events that occur infrequently and have a significant impact on a company's earnings in a specific period. Examples of one-time events include mergers and acquisitions, large contract wins, or major regulatory changes. These events can lead to a temporary surge or decline in earnings, which may distort the P/E ratio. Investors should assess whether the one-time event is truly non-recurring or if it has the potential to impact future earnings. the impact of accounting practices, non-recurring items, and one-time events on the P/E ratio depends on how investors interpret and adjust for these factors. Some considerations include adjusted earnings. Investors may adjust reported earnings by excluding non-recurring items or accounting adjustments to calculate the company's adjusted or normalized earnings. Using adjusted earnings can provide a clearer picture of the company's ongoing profitability and help in calculating a more meaningful P/E ratio. Forward-looking analysis. Instead of relying solely on historical earnings impacted by non-recurring or one-time events, investors can focus on future earnings expectations. Analyzing forward-looking estimates can help incorporate anticipated changes and adjustments, providing a more forward-looking P/E ratio. Comparative analysis. When comparing the P/E ratio of a company to its peers or industry benchmarks, it's important to consider how accounting practices, non-recurring items, and one-time events may differ among companies. Adjusting earnings or normalizing them across the peer group can help ensure a more meaningful comparison. It's crucial to consider these factors in conjunction with other fundamental analysis and qualitative factors when interpreting a company's P/E ratio. By understanding the impact of accounting practices, non-recurring items, and one-time events, investors can make more informed assessments of a company's valuation and its future earnings potential. Conducting fundamental analysis is crucial for evaluating the accuracy of reported earnings and gaining a deeper understanding of a company's financial health. Fundamental analysis involves a comprehensive examination of a company's financial statements, business operations, industry dynamics, and qualitative factors. Here's why conducting fundamental analysis is important in evaluating the accuracy of reported earnings. Detecting accounting irregularities. Fundamental analysis helps in identifying potential accounting irregularities or manipulations that can distort reported earnings. By examining the financial statements, analyzing trends, and understanding accounting policies, investors can spot inconsistencies or red flags that may indicate aggressive accounting practices or fraudulent activities. Assessing financial health. Fundamental analysis allows investors to assess the financial health and sustainability of a company's earnings. By examining key financial ratios, such as liquidity ratios, profitability ratios, and leverage ratios, investors can evaluate the company's ability to generate consistent and reliable earnings. This analysis helps in verifying whether reported earnings accurately reflect the company's underlying financial position. Evaluating cash flows. Fundamental analysis includes analyzing a company's cash flow statement, which provides insights into the actual cash generated by the company's operations. Examining cash flows helps in verifying the quality and sustainability of earnings. A company may report high earnings, but if its cash flows are weak or negative, it may indicate potential issues with revenue recognition. Aggressive accounting, or unsustainable business practices. Understanding business operations. Fundamental analysis involves a deep understanding of a company's business operations, industry dynamics, and competitive positioning. This understanding helps investors assess the company's ability to generate consistent earnings over the long term. By evaluating the company's competitive advantage, market share, growth prospects, and potential risks, investors can gain insights into the accuracy and sustainability of reported earnings. Comparing to peers and industry benchmarks. Fundamental analysis allows for meaningful comparisons of a company's financial performance and earnings to its industry peers and benchmarks. By comparing key financial metrics and ratios, investors can assess whether a company's reported earnings are in line with industry norms or if there are significant deviations that warrant further investigation. Identifying non-recurring or one-time events. Fundamental analysis helps in identifying non-recurring or one-time events that may impact reported earnings. By understanding the nature of these events and their potential impact on future earnings, investors can make adjustments to reported earnings to arrive at a more accurate assessment of the company's ongoing earning power. In summary, conducting fundamental analysis provides a holistic view of a company's financial health, business operations, and industry dynamics. It helps in evaluating the accuracy of reported earnings, detecting potential irregularities, and assessing the sustainability of earnings over time. By combining quantitative analysis with qualitative factors, fundamental analysis provides a comprehensive framework for evaluating the accuracy and reliability of a company's reported earnings.